In this week's video, we'll cover a rare S&P 500 trend signal that was flashed this week and ask and answer, what does it mean for stocks? We'll be covering three key areas this week. The first relates to DeMark exhaustion counts. This is an S&P 500 daily DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies, LLC. DeMark counts speak to the probability of exhaustion, trend exhaustion, telling us when you see a 9 paired with a 13, the probability of a trend reversal is higher. It's relatively rare to see an R like this, and it's telling us that we have an extremely strong trend, and DeMark wants to recycle the DeMark count. It's also noteworthy that we saw similar recycles on the S&P 500 60-minute chart this week. You can find more detail on this topic by Googling the title on your screen from a November 15th, 2019 Short Takes post. So we have a recycled count on the combo count on the daily chart of the S&P 500. How many times have we seen something similar dating back to 1982? The answer is only 6 previous times. And how did the S&P 500 perform walking forward? The answer is quite well. From the date of the labeled recycle count, every single case the S&P 500 was higher 1 month later and 3 months later. Average 3-month gain, 7.85%. Median 3-month gain, 8.9%. Worst historical outcome, 4.41%. And the longer-term outcomes, looking at 1 to 5 years, align with our keep an open mind about better-than-expected outcomes from a longer-term perspective. Might also be helpful to know to capture the 3-month returns here, the 6-month returns here. What type of drawdowns did investors have to experience? In all 6 cases, from the date of the labeled R, which in our case occurred on August 20th, drawdowns looking out 1 week, 2 weeks, 3 weeks, 1 month, and 3 months were really next to nothing. In most cases, the market never looked back. The largest maximum drawdown from the date of the labeling of the R on the chart was less than 1%, simply telling us that it's possible that the very, very strong trend that we have may continue to push higher, helping us keep an open mind about a wide range of outcomes on all time frames. The median drawdown looking out 1 year was also next to nothing. However, we do have 2 cases. The last case saw a 27% drawdown from the date of the signal. The 2010 case, between the date of the labeling of the R on the chart and 1 year later, drawdown was 18.64%. Helping us with the other end of the spectrum, keeping realistic expectations about normal and to-be-expected volatility, pullbacks, corrections, and bear markets, and also helping us keep realistic expectations about a wide range of outcomes. Last week, we said the market was hesitating and that it was very, very important in the short run to trade the chart in front of us. Relative to what's transpired over the past 5 trading days or past week, does it align with or contradict everything that we've been covering since early April of this year? It's the chart of leveraged loans. Nothing alarming here. Last week we said the Dow Jones Industrial Average looked like it had a successful breakout above the June high, and this might have been a retest. This chart is dated August 20th. The Dow was up 611 points this week over the past 5 trading sessions. This is the look here. Here's the breakout, the successful retest. It still looks like a successful retest. Notice, even if the trend remained in place, wouldn't be unusual to come back and tag this trend line. Last week we said in the short run, really didn't have to predict anything, just had to pay attention to the charts. Were they helpful this week? Yes, during Monday's session we said almost every hesitation chart moved in a favorable manner, telling us to keep an open mind about better than expected outcomes on Tuesday, Wednesday, Thursday, and Friday. Last week we said we had evidence in hand telling us to keep an open mind about a potential pullback in a 1 to 3 month time frame, but we also said the chart last week from a longer term perspective basically looked fine. We can say the same thing a week later. This chart is dated Friday, August 28th. This week, 10:25 a.m. Friday morning, the S&P was up 93 points between this chart and this chart. Everything that we just said about the previous two charts applied to these two charts. A week ago, we said nothing particularly alarming here. Present day, nothing particularly alarming. Yes, we're extended here, but we really don't have any evidence in hand that tells us this trend is in doubt. Once again, wouldn't be shocking to pull back towards the trend line or even into this area here at some point. Major topic number 2, long-term breakouts. You can find a detailed description of this chart in last week's video. Similar theme, hesitation or imminent reversal. Last week we said this was a constructive look, but we also noted last week this is a failed bearish breakdown, and we had to keep an open mind about a failed bullish breakout. Here's the look of the chart last week. How does the exact same chart look today? Better, worse, or about the same? The answer is better. 10:30 a.m. Friday, August 28th. QQQ is outperforming TLT by 6.57%. Same comments as last week. Right now, this chart looks constructive. And this could be a very significant breakout given the consolidation dates all the way back to calendar year 2018. Remember, the weight of the evidence builds over time. Can't forget, back on June 5th, we had that extremely rare 10-day breakaway momentum thrust that we covered. Typically, really good things happen following similar thrusts. Lower left-hand corner of the screen, last week we said we hadn't seen anything yet that would negate that 10-day breakaway momentum thrust from a drawdown perspective, but it also told us to keep an open mind about a pullback. Same comments today. August 28th, we're printing a new rally high. All of the pullbacks that we've seen thus far, not particularly alarming. Covered this topic last week. It's still relevant. We must remain open to all outcomes from wildly bullish to wildly bearish. That's how we maintain maximum flexibility. This is 2018 here. This is a downward sloping trend line in favor of TLT from a long-term perspective relative to SPY. The third major development this week also relates to this portion of the chart here. And that third major development is a major shift in Fed policy. In many ways, the Fed is acknowledging this deflationary trend here. Market action following the March 23rd low tells us that Fed actions are extremely important relative to probabilities. This is the word major, followed by policy shift. And if you think about it, off of the low, the NASDAQ and the NASDAQ 100 have been the leaders. They were the first ones to break their major fibs. They were the first ones to exceed the June highs. They were the first ones to go on to make an all-time high. And the S&P followed in every case, and now the Dow is also trying to follow. Thus, it's quite possible that the look of this chart here will improve because the NASDAQ 100 QQQ relative to TLT has now cleared those levels. This is basically the 2018 level. This is the 2020 level, higher. 2018 level, 2020 level, lower. There's no question that this chart helps us keep an open mind about worse than expected outcomes, and it helps us maintain maximum flexibility. That's a good thing, not a bad thing. Here's a close-up of SPY TLT that we covered last week. If we updated the chart, the ratio would be about right here, because as of Friday morning, SPY was beating TLT by 5.42% for the week. Here's the ratio during Friday's session. It's up to 2.16, right around this area here, well above the June high. We'll continue to take it day by day based on the evidence and trade the chart in front of us. Even if really good things happen longer term, we will most likely continue to peel off some profits along the way. Trade the chart in front of you. Last week, indecisive look, RYT relative to IEF. 1 week later, better, worse, or about the same? The answer is better, exceeding the June high. Said SPY IEF was running into an area of potential resistance. Here's a stall look here. Looked quite a bit better as of Thursday's close. Similar concepts here, SPY TLT. Here's the June high. Here's your stall, kind of a failed breakout look. Here's the stalled, failed breakout look. Looks a lot better as of Thursday's close, well above the June high. Banks, still a mixed bag. One good thing on this chart. We're still holding this dotted orange line that we covered last week. Interest rates, last week we said all things being equal, if you are a stock market bull, you would prefer this breakout here to hold. This is the look of the chart last week. It does look a little bit better this week, making a higher high relative to this high as of Thursday's close. Still need to clear this area here. Trade the chart in front of you. Last week we said we would learn something either way relative to JNK versus IEF. Here's your stall look here near the June high and under the 61.8% retracement. As of Thursday's close, above the June high with some progress in the right direction. Similar situation here, JNK TLT, lower high, at least making progress Monday through Thursday. The ratio was up 3.65%. We said slowing momentum on this chart last week was concerning. It's still concerning, helping us keep an open mind. Some encouraging signs from a momentum perspective relative to price, and you have to make sure that you're not putting too much weight on relative charts. It's also important to look at RSP in isolation, and it printed a new weekly closing high this week above the June high here. Basically telling us, since this chart was shown last week, both RSP and SPY made progress. Last week we said breadth was a little bit concerning. We'd like to see it improve. We did see some improvement this week, including the stats as of 11:57 a.m. Eastern Time on Friday, and they looked even better near the close on Friday, August 28th. The only sector that was down on Friday, defensive-oriented healthcare. The AD line, new highs versus new lows, advanced decline volume, all looked much, much better this week relative to the past 2 weeks. It's not all butterflies and rainbows. Our concerns mentioned last week still apply this week relative to the monthly chart on your screen. Similar to RSP divided by SPY, airlines divided by the S&P 500 consolidating as of last week, made some progress this week. This isn't particularly bullish or bearish at the present time. Last week, small caps relative to the S&P 500, a discernible lower high relative to the June high. This week, a lower low and some signs of deterioration. Remember, this is a relative chart. It doesn't necessarily mean small caps are a dog. It talks about opportunity costs and how much weight you might place to small caps relative to the S&P 500. Growth stocks versus the S&P 500. Last week we said it made a new rally high. This week it continued to print new rally highs, was up around 1 p.m. on Friday, August 28th for the week, 0.68%. Growth versus bonds. Last week we said there were some encouraging signs on this chart. This week printed a new high relative to the 2020 high and still well above the June high. Gold looking a little bit shaky last week and earlier this week. Had a nice rally on Friday and trying to hold near an important level. Gold versus bonds last week. This week, somewhat of a mixed bag. Broke the line here, but pushing higher again. This is really just consolidation in here, GLD relative to IEF. Gold versus stocks, GLD versus SPY last week. Somewhat of a mixed bag. From a negative perspective, we broke this upward sloping trend line, but we're trying to make a stand here where this original breakout occurred. For the most part, gold still looks good, but we have to remember, this is March 23rd, and on a relative basis, it has been underperforming since the stock market bottomed. On a longer-term basis, gold is still outperforming stocks. Remember, last week we said this is an opportunity cost line here. We're right on it. Home construction relative to the S&P 500, really no change, still holding this breakout here. Transportation versus the S&P 500, really no change. Treading water, a breakout here, would like to see some progress here. Remember, this is a relative chart. If we looked at IYT in isolation, it would look much better. Similar concepts here. High beta versus S&P 500 really closed right on this dotted line. And this week, it looks like it's trying to make a stand at the line. Point of showing this chart, it's not particularly bearish at this point. This is still just hesitation. And we also have to acknowledge that this high is well below this high. Low volatility versus the S&P 500. Last week we said this really doesn't look like fear relative to market participants. If it did, we would expect the ratio to be moving like this. And this chart was also helpful during the week. After the close on Tuesday, we noted that it had made a new rally low relative to the S&P 500, and that was helpful relative to the gains on Wednesday, Thursday, and Friday. Here's the look of the chart at 1:08 p.m. Friday. New low relative to the point where the S&P 500 bottomed on March 23rd. The consolidation in this case is breaking to the downside. Last week we said we had to be aware of potential resistance at 34.86. And remember how we said the NASDAQ and QQQ have been leading the S&P and the Dow, and sometimes they can help forecast what's going to happen with the lagging indexes. We can say the same thing a lot of times relative to the S&P 500 and the S&P 500 futures. Therefore, it might be helpful to know, how do the futures look relative to a similar area of resistance? The answer is they've had 3 consecutive daily closes above the similar area here, telling us it's possible that the S&P 500 will exceed this level here. That's to be determined. And really, we're talking about it's possible the S&P 500 will exceed and hold above this level here. Last week, we said the DeMark count had been negated, and that told us to keep an open mind about better than expected outcomes this week. We did get much better than expected outcomes this week. And let's think about price and market action relative to everything we've talked about since early April, relative to the recycled DeMark count that we covered this week, the long-term breakout in QQQ relative to TLT, and the major policy shift that took place at the Fed this week. Does price action align with the bullish probabilities? It's difficult to say no in the short run. The S&P 500 was up 110 points this week. And sometimes it's helpful for clients to hear from a third-party source. Tweet this week, Turning Point Macro Research, Twitter handle where my cursor is. The weight of the evidence continues to favor a cyclical uptrend in stocks. None of this predicts what's going to happen next week. It simply speaks to probabilities. And again, 1, 2, and 3, and now 4. Does it align with or contradict the weight of the evidence that we've been covering from a bullish perspective since early April? Nothing really new here. I think the comments from last week still apply. The only difference is most of the charts have resolved themselves in the short run in a bullish manner. That doesn't mean they're going to stay that way. These charts will still be helpful. Every statement that we've made this week is a probabilistic statement based on the chart in front of us today, based on the weight of the evidence, based on the facts that we have in hand today. If the charts, the data, and the weight of the evidence shift in a meaningful way, we have to be willing, 100% of the time, to reassess the probabilities. The charts in front of us were helpful over the past 5 sessions. If we review them with an open mind next week and in the coming weeks and months, they should be helpful as well. And as we know, the only way that we can do that effectively is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.